The stock market has spent months breaking all-time highs, propelled by a surge in the artificial intelligence sector that has added trillions in value to a handful of companies. Amidst this surge, Warren Buffett, the investor who famously advised others to be greedy when others are fearful, is doing the opposite. Berkshire Hathaway's current portfolio reveals a significant disparity. Only 43% of their holdings are in active stocks. The other 57%, totaling nearly $189 billion, is sitting in cash and short-term treasuries. For an investor who built his career on long-term equity growth, holding more cash than stock suggests he no longer finds the current market prices justifiable. To find the logic behind this move, we look at the Buffett indicator. This chart shows the historical 100% baseline, where the stock market and GDP are in balance. In the year 2000, equity shot to 162% of GDP before the dot-com bubble burst. Today, that number has reached 220%. This is the highest reading in its history, surpassing the levels seen before the COVID-19 market crash. This trend is corroborated by the Shiller P/E ratio, which adjusts corporate earnings for inflation over a 10-year period to smooth out short-term volatility. Current Shiller P/E levels are now approaching the heights seen in 1929, just before the market suffered its most famous collapse. Much of this valuation is concentrated in a single sector. The AI industry is currently valued at approximately $32.5 trillion. To put that $32 trillion into perspective, the entire annual GDP of the United States is currently under $30 trillion. A single technological sector is now mathematically larger than the entire output of the U.S. economy. When valuations become this concentrated, the market's stability relies on those few companies continuing to meet increasingly impossible expectations. Combined, these metrics describe a market that is mathematically overextended, creating a scenario where even a minor disappointment could trigger a significant correction. Overvalued markets can persist for a long time, but historical cycles point toward a specific window where these tensions often resolve. Since 2010, the S&P 500 has shown a consistent seasonal pattern. While the first half of the year is generally positive, August and September have historically been the only months to average negative returns. This year, the seasonal weakness aligns with the midterm election cycle, which introduces uncertainty regarding the balance of power in the House and Senate. Historically, this political uncertainty leads to increased volatility in September and October, as investors move away from riskier assets like tech and small-cap stocks. The intersection of record-high valuations, seasonal weakness, and political transition creates a historically volatile environment. Does this convergence mean a total systemic collapse is imminent? Examining the S&P 500 during the last 3 midterm election years, we see a recurring pattern of corrections occurring during this late summer window. In those instances, the market didn't collapse. Instead, it underwent corrections ranging from 10 to 20% before finding a floor. Buffett's decision to hold $189 billion in cash suggests he is preparing for exactly this kind of drop. He is maintaining dry powder, liquid reserves that allow him to purchase high-quality companies at a 20% discount the moment the correction hits. Following the oracle's lead doesn't mean exiting the market in fear. It means shifting toward a defensive posture, ensuring you have the cash ready to buy